And joining me is David Lawman at the Beef Cow Research Range Unit, North Range. Dave?
Yeah, Extension Beef Cattle Specialist. Thanks for participating in the Ranchers Thursday Lunchtime Series. We're excited to see what our tax specialist, J.C. Hobbs, has for us here today. As we go along, don't be afraid to type any questions in the chat or the Q&A, and we'll get to them probably at the end of our presentation today. And then there should be a survey on your way out. If you can take just a few minutes to help us answer some of those questions for future programming, that would be helpful.
So today we have J.C. Hobbs. He's a Oklahoma State University Cooperative Extension Service extension specialist. He's been with the extension since 1985. He has degrees in Ag-Econ and accounting from Oklahoma State University, along with a Master of Science in Ag Economics from OSU as well. And his focus is primarily on farm income tax management, estate planning, business management, and farm transition planning. And today he's going to talk about tax strategies for cow-calf enterprises. So JC, we'll give you control of the operation, and thank you very much for joining us.
Thanks for having me. A very timely topic in some areas, and a topic often that most of us really don't like talking about is taxes, because simply it's not a very sexy topic. Let's go ahead and jump in this for the essence of time. So we're going to hit upon some of the tax management objectives. First off, what we want to do is remember that minimizing taxes is not our goal. After tax profit maximization is the objective. Taxes is basically a cost like any other cost of doing business. Same consideration as buying feed, hay, buying cattle, etc. It's a cost. We want to minimize it, but we don't want to pay. But remember, profit maximization is the idea. Do not let the tax tail wag the business dog. When we start minimizing taxes, what we usually end up doing, and it's very easy to do, is you end up overinvestment in capital assets, because the current rules and laws of the income tax allows us to use depreciation. So buying equipment, buying depreciable items reduces taxes very quickly. Problem is, sometimes we overinvest in order to minimize those the tax bite. Keep in mind, tax management, that's the minimum legal tax. It's allowed. Tax evasion, don't do that. So why is it important to pay taxes? It means that we're making a profit. So the more taxes you pay, the more profit you're making. Also, paying taxes, you increase your Social Security benefits. So when we retire, the payment of Social Security or self-employment taxes reaps the benefit. We'll have income when we reach retirement age, 62, 66 plus, or 72. What I run into frequently is farmers and ranchers come to me with their ready to retire. We start looking back at their retirement or their history of paying into self-employment or Social Security, and their benefits are very low. Ends up they can't retire to where they thought they could. Another reason that you want to pay self-employment or Social Security, it's disability coverage. So you become disabled, or you get survivor benefits if something happens. Those go to you or your surviving spouse. Without those, you are left out in the cold, or they are as well. So there's a lot of reasons for wanting to pay taxes. So what we're going to get in today, and we're going to cover some of these quickly. We're going to cover some of it in more depth. The net operating loss rules, those have changed since 2018. Deferring income, something that we all like to do. postponing recognition to years when we have less income. We'll talk about some income averaging. The reason for this is there's information from the Internal Revenue Service that this is not being used like it should be. Prepaying farm expenses, depreciation alternatives, and some things I've been running into in the last couple of years that's been a little bit eye-opening to me. Those errors. So the net operating loss rules, they've changed. The rules now for the current year and starting or ending January 1 or December 31 of 2025 is that we've made some pretty significant changes in the overall net operating losses that we're allowed to take from a farm standpoint. Farmers have more benefits from these than some other individuals or other businesses. So the net operating loss deduction, it's now limited to 80% of taxable income in any year that we carry it forward to or carry it back to, as well as the year that it occurs. So what happens for most other businesses, it's the losses can't be carried back, but farmers still can carry losses back. What this does is gets an immediate tax refund for those prior years. By doing so, we end up increasing the cash flow in the current year by allowing that carry back. There's also the ability then to carry forward any unused amount, or if we don't have any reason to carry it back, it can be carried forward as well. It used to be a 15-year limit that we could carry it forward. Now it can be carried forward until it is fully absorbed, but there is an 80% of taxable income limit that's allowed in any 1 year as we carry it forward. So net operating losses, something to keep in mind. Bring this up to your tax preparer, tax advisor, if this does occur. Income averaging, a tool that IRS says is not being utilized efficiently. Most of our tax preparers, for some reason, aren't using it. What happens is we get a year, we've got a lot of income. This could be this year if you have income from sales of livestock due to the drought, and you don't want to take the drought rules, the weather-related livestock rules. We'll talk about those in a minute. So what you do is you take the high income or large amount of income, and you're allowed to carry that back to 3 prior years when we had less income. It works best in that situation where the income in our prior years is lower than the current year. So our income tax brackets are below the current year. We can select what income to use so that we can play the game of maximizing the current year benefit as well as carrying it back and getting some refunds in those prior years. So income averaging, what it does is gives us some relief from high taxes this year, allows us to get some lower tax rates from the prior years used up. However, it does not impact the self-employment tax. That's applied to this year's current farm income, business income. Like I said, the reason I bring this up, it's underused. There's a lot of tax benefits that are being left on the table because our preparers aren't using it, or we're not telling our preparers to use it. Another thing that we can do is deferring income. Income in certain scenarios can be pushed forward into the next year. So if you're looking at what takes place here, you have to be a cash basis taxpayer, which 99% of the farmers in Oklahoma, farmers and ranchers in Oklahoma are. You have to make sure that you don't get receipt of the income in the current year, so you receive the income in a later year. So it's a deferred payment contract. Here's how it works. We decide to sell crops and livestock in the current year. We're not going to receive a payment into the following year. It works better from the standpoint of crops than it does livestock. Livestock's a little bit harder to handle because of the rules that do apply, but it can be done if we have the proper contract. Weather-related sales is primarily what we see as the ideal way of deferring receipt of income. Now, Dave and I were talking about this a moment ago. We're seeing a lot more of this. I didn't put the slides into this material, but there's 2 sets of rules for weather-related sales of livestock. One applies to breeding, dairy, and draft animals. We can defer the reporting of the income from the sales of those. So we sell those animals in this year. We have weather-related conditions, that's severe, extreme, exceptional drought conditions that are occurring. We are then allowed to not recognize the gain on those sales. We simply make an election at year end that we want to replace those within a 2-year time span. By doing so, we force or push that income recognition into a year much later, essentially when those replacement animals are sold. So the weather-related sales, as it applies to draft, dairy, and breeding animals, we have the ability then to postpone the recognition of the income by electing then to decide to replace those. That's one set of rules. Now, if we happen to be in a situation where we have a federally declared disaster area, and I expect many Oklahoma counties will receive this declaration before the end of August. In August, the IRS publishes a list of counties that qualify for the disaster designations. What this does for us. So if we have weather-related sales of livestock, it can be draft, dairy, breeding, or it can be any other livestock, market animals, other than poultry, that we have to sell animals in excess of normal this year. We can then report the excess sales when they would normally be reported in the following year. So it allows us to avoid the bunching of income. At the end of this webinar, if you'll come back to the website, I'm going to put together, or I'll have posted a fact sheet that I wrote several months ago that talks about weather-related sales of livestock, how it's treated, what the rules are, how to make the election, what all the pieces of the puzzle are. It can definitely help reduce the bite of having to sell animals in excess of normal current year, when normally those animals would have been sold at a later year. Also, crop damage payments, crop insurance payments, if it's not for revenue, if it's for crop damage, the amount that's in excess, again, that we normally sell in the following year for the crop can then be postponed and reported. So we split the crop damage payment in the year that we would normally sell part of the crop and the year that we sell the remaining portion. So this deferred payments, deferred income is a way of, again, managing how we report taxes and how we end up avoiding, again, bunching of income when we really don't want that to happen to us. Prepaying expenses. I see this some degree, especially in livestock production where we're buying feed. You're buying feed this year to be used in the following year. This works well to, again, if we know that we're going to have a large amount of income this year, let's buy some extra feed that we're going to be using next year. This is allowed. However, there's some things we have to look at. It has to be an actual payment. We can't just deposit money at the co-op or the feed store. It has to be a payment for those, and the delivery has to be, will have to occur. If it's simply a deposit, you have the right to get that money back. IRS says that's not a prepaid expense. Simply a deposit, what doesn't work. It has to be made for a valid business purpose. I like this last one. It says the IRS rules must not materially distort income. If I knew the answer, what that means, I would tell you. But basically, I think what it means is you don't want to buy 2 years worth of feed this year. But again, material distortion of income is kind of a gray area. So prepaying expenses, what happens? Your deduction is limited to 50% of all other deductible non-prepaid expense. What does that mean? So we buy $20,000 of feed this year that's going to be used this year. We can buy another $10,000 and go ahead and deduct that in the current year. That's less than 50% or 50% or less. That's what that basically means. We can't buy 200% of the normal we would expect to buy. It's going to be somewhat limited. However, if we are on the farm, main home is on the farm, or our principal occupation is farming, more than 50% of our income coming from the farm, if a member of our family meets either of those two rules, we can avoid that deduction limitation because we're a qualified farm taxpayer. There's another exception, flood or drought. If it causes our feed use not to be used up because all of a sudden we got rid of those animals, that allows us then to an exception. So we don't have to postpone reporting the income. We actually get to report it this year. So basically you're not using what you initially purchased. So it gives us an out. Now, some things that have changed in the last several years. We're going to quickly brush through these. Is depreciation update. So the first year additional bonus depreciation. Some rules did change with the Tax Cuts and Jobs Act of 2018. I'm finding preparers that still don't fully understand this. So what I would suggest, if you feel like your preparer is not taking advantage of these rules, get a copy of the slides and take them to your preparer and let's go through them. So the first year additional bonus depreciation, when it originally came out, it was for new assets only, had to be purchased brand new, never used by anybody else. Well, we found we weren't getting enough investment in assets, growing businesses, etc. It was changed and it's now new or used assets. And we're allowed to take 100% of the cost of that particular item and depreciate it, take it as depreciation deduction for 2022. So if you buy a new tractor and you spend $200,000 on that tractor, as long as we have the taxable income to support it, we can deduct that full amount in 2022. Now, in 2023, that amount of deduction goes down and it continues to go down until January 1 of 2027 when it goes to zero. Now, the interesting piece upon the bonus depreciation, we brought this about in 2008. It was going to sunset several times. It keeps being brought back. So whether or not we see a change coming next year, it'll be interesting to see whether or not we bring that back to 100%. We have never had a situation in the past where this has begun the process of sunsetting. The next piece is the Section 179 expense election. This has been around a very long time. However, it was always or was never made permanent. It was subject to change every year. Now it has become a permanent part of the legislation. And the amount that's allowed every year for the 179 election is increased by inflation. So if you look at 2022, the amount that we can buy and write off is $1.08 or $1,080,000 of investment in machinery and equipment. Don't run into many farmers that hit that limit, but it can happen. And then there's also a change to our normal depreciation rules. In 1986, we came up with what we call the Modified Accelerated Cost Recovery System. It shortened some of our depreciation periods at that point in time. It also brought in some new rules, etc. Well, with the Tax Cuts Jobs Act, we modified some new things that applies to farmers. Used to be that farm machinery and equipment was a 7-year asset. In other words, it was depreciated over a period of 8 years. It took a half a year in the first year and a half a year that was then allowed to be taken in the 8th year. So basically, it's over a period of 8 years, you fully depreciated it. Now for new farm machinery and equipment, new farm machinery and equipment is 5-year property. And we're also then allowed to, instead of the old 150% declining balance, we're allowed to take the full 200%, which is now, we write it off even faster and to a greater percentage. This greater percentage applies to 3, 5, 6, and 10-year property. Basically, that's everything we use in a farm business except multi-purpose structures. So a single purpose structure we use for grain storage, hay storage, etc., does qualify in this short, fast write-off. So some of the rules that apply: bonus depreciation. You have to elect out of it if you don't want it. In other words, if you buy a piece of equipment, it is assumed that you're going to use the bonus depreciation. Your accountant takes care of this. If you don't want to use the bonus rules, you have to elect out. One neat thing about bonus is it can create a farm loss, and it can offset W-2 wages as well as other income. So if we have income from oil and gas production, we have income from wind turbines, and we need to buy a piece of equipment, we can write it off and offset that other income. Also, conversion to personal use. It doesn't require recapture of the excess over what would have normally been allowed. What does this mean? Last year, I had some or about 2 years ago, we haven't been able to buy pickups, etc. But a couple of years ago, had a couple of farmers come up to me and said, we want to replace our farm truck. And we're also the stock trailer. And they bought a new pickup and trailer. Then they decided that they wanted to take the pickup and convert it to personal use a year later. They could do so without recapturing any excess depreciation. So the bonus depreciation was very unique. It allows the farmer, if they wanted to buy a pickup, or a businessman to buy a pickup on December 31st, use it for 1 day, fully business use, 100% business use, and in January, decide we're going to convert it to personal use. This was allowed. That was a loophole in the tax law, and it still exists. It can be done. Be careful, though, if you decide to do it. Now, the 179 as a contrast, you have to elect to use it. So you have to elect out of the bonus, but you have to elect to use the 179. And the neat part about the 179 rules is you can pick up a specific asset or a group of assets, or you can even decide, oh, I only want to offset 50% of that cost using 179 and depreciate the rest of that under a normal depreciation method, or even elect to carry that unused amount forward to next year. So the 179 rules allow us a great amount of flexibility from the standpoint of tax management and planning. It also allows us a great amount of abuse if we so desire. Now, one of the things it cannot create is a farm loss. So when we write the net farm income down to zero on the Schedule F, we can't go any further, but we can offset W-2 wages. So essentially, we can't create a loss, but we can offset W-2 income and create or reduce our taxes that way. But conversion to personal use will require a partial recapture at amount over our regular depreciation that was allowed. Remember, bonus doesn't require that. Section 179 does. So we're looking at buying a piece of or pickup or a truck or something that we're going to use for personal use at a later time. 179 may not be your best option. Bonus may be. And again, you can pick and choose how much of the assets cost you want to apply, as long as it's greater than 50% or 50% or more. Some other things, like I said, changed. New farming machinery, that occurred 17. 5 years for new equipment, machinery. Grain bins, fences, cotton ginning equipment, still 7, didn't change. So new equipment can be now over 5 years. And we also can apply the 200% declining balance. Again, something that your tax preparer may need to have their memory jogged. What is new equipment? Now, this is a great question. So it's never been placed in service or used by anyone other than the current owner. Now, some fun stuff we had with the IRS. We asked them to define what a new heifer was, a new cow. They couldn't give us an answer. So just a couple of years ago, they actually got somebody in their legal department, and this is what they defined it as. Original use applies to the owner when she is bred for the first time. We brought up the question, so we've got a farmer, rancher, that breeds heifers, and then he sells those to others to go into the breeding herd. These are treated like market animals. IRS still hasn't addressed that. If you're breeding heifers to sell to somebody else, you don't hold them for the required period of time. Really, those don't qualify. So heifers that you keep, the day that she's bred, that becomes the day that you're allowed to take depreciation on that animal. Same thing with a new bull. That applies with the owner of that animal when he's first used as a herd sire. Some issues that are popping up, and these have come up recently, and it was eye-opening for me when we're looking at reporting livestock sales. Here's what's happening. I was reviewing a tax return for the farmer it's been a year ago. And what I found is the preparer that the farmer is now using, his prepared retired, so he got a new one. His new preparer, really not too familiar with agriculture, he put livestock sales, all livestock sales, on Schedule F, wrong form. Basically, what should be on Schedule F are those items subject to ordinary income tax and self-employment tax. What are they? Sales of market animals. They can be animals that you raise, that you sell, or animals that you purchase and resell, like stockers. Those are reported on Schedule F. Co-breeding animals, those are being reported on F. They should be reported on 4797. The reason for that, you get the favorable capital gain treatment. And I'll show you what those numbers really mean in terms of the tax rates here in just a moment. So if this is occurring, be careful. Review your tax return. Schedule F, what should be there is line 1, the sales of purchased livestock. This would be sales of stockers, not sales of cows you buy. That's what they're looking at. They said, well, they were purchased livestock. You know, those are breeding animals. It has to be market livestock to go to Schedule F. So the cost of those animals on line 2, the net sale. Then comes line 4, sale of raised livestock. Again, the confusion is raised breeding livestock being reported here. This would be raised animals like steers. Heifers not going to go into the breeding herd. They're going to be market animals. Also, if we're selling heifers that we are breeding and normally selling to others, those would fall here in this line 4. What doesn't fall here are breeding animals, no matter whether they were raised or purchased, cows or bulls. Those go on Form 4797. The rub, if we report them in the wrong place, net farm income, the Schedule F income, it's subject to the 15.3% self-employment tax. Breeding livestock do not fit the rules for ordinary farm income. That sale is not subject to SE tax. It's not subject to that 15.3%. So if we're reporting in the wrong place, what we do is we're paying more tax than we need to. Again, only sales of market animals should be reported on Schedule F. Form 4797, that's for sales of business property. Raised breeding animals, purchased breeding animals, those are business assets. They're used in the production of income. We're selling their production. So put them here. Make sure that your accountant is reporting them correctly. These are the cows, the bulls, replacement heifers that are sold. So we breed a heifer. She doesn't go in the breeding herd. The goal was to put her there. Well, she's not a market animal. She is a business animal. The rules say you have to hold them more than 2 years to get long-term capital gain treatment. Again, that's where we get the greatest benefit from reduced tax rates. If for some reason we don't hold that replacement heifer for that 2-year period or any breeding animal for more than 2 years, it's short-term capital gain. That's under the short-term gain rates, ordinary income rates. But remember, it's not subject to self-employment tax. So make sure, review with your accountant before you sign off on the return to make sure the items are reported correctly. I've found that this happened more than once in Oklahoma. I've talked to others in other states. The same scenario is happening because we've got preparers that are not familiar with agriculture, and not an uncommon situation. So give you an idea of what I was talking about and the reason why we want to make sure that we take advantage of the capital gain rates. If you'll notice that our ordinary income tax rates, and this applies for married filing jointly, they start out at 10% of taxable income above 20 or up to $20,550. Then they start ratcheting up. 10, 12, 22, 24, 32, 35, and 37% is the maximum. And that's for the normal situation of our taxpayers. So look at that very closely. What you want to make sure of is you pay as little tax as possible. Now we get into the capital gain scenario. So capital gains, if we're looking at the current law, they range anywhere from 0 to 20%. Most of our capital gains for farmers and ranchers will hit that 15% rate. So look at where on the far right-hand side. So income, capital gain income, less than $517,000 will typically trigger a 15% capital gain rate. Let's go back and look where 15%. So 517,000 is there. You would be in the 35% bracket if you reported that, or the 32 to 35% bracket if you reported that income as ordinary income versus capital gain. So therefore, it becomes very important to make sure that we put things in the right place and we don't overpay our tax. So should you want to pay taxes? Yes. It means you're making a profit. One of the things that never will always take place, Uncle Sam's never takes all of your income, all of your profit. The maximum ordinary income tax rate is 37%. And remember that we only pay that last portion at the 37% rate. We pay some at 10, we pay some at 12, we pay some all the way up to the top. You want to pay taxes, but you don't want to leave a tip. So pay what's required under the law, keep yourself in those realms, and make sure you don't leave a tip. One other thing that I failed to mention, and if you come across this, the IRS is currently doing quite a few audits on hobbies. And hobbies or farms or ranches become triggered when we have income or profits or losses rather occurring in 2 or 3 of the last 5 years. The only thing IRS is doing right now with those is they're wanting information. They're coming to farmers and ranchers asking for additional information. So if you get a letter saying that you're been triggered for as a hobby, get with your tax return preparer immediately. All the IRS is really wanting to do at the current time is verify that you are in the business of farming. You have a business objective, you have a business plan, you're growing your value, your net income or net worth is increasing, etc. The reason for the loss is due to drought, weather, other issues. So things you're doing right, all of the audits that I've had so far, we've been able to prove that we are in the farming business, even though losses have been occurring. It's a situation where we're of the environment that we're in, triggering the IRS to start questioning. All they're doing is sending out letters. Most of what they're doing is being taken care of over the phone or via a response from your preparer. So something not to panic about. Just be prepared, just be aware that it is occurring. So as I mentioned, let's go into some detail on the weather-related sales. A little bit more information than what I've given you. So remember the 451G, you might want to write this down. It's also in the information I will post on the website. It applies to sales of all animals other than poultry. It allows the sales in excess of normal to be referred to the next year. So it keeps us from bunching income so that we don't end up in those higher brackets in the current year. So the 451G, it's there. It applies to everything. It does require a federally declared disaster area. And if you look at it right now, I would say that we're probably going to get that. The IRS looks at the level of drought that's been occurring. Also, if there's been fires that cause an area to be declared a federal disaster area, then that applies as well. And it doesn't necessarily have to apply just to the county that you live in. If you are in a county that's adjacent to it, connects, it applies to you as well. So look at your county and the counties next to you. That's how the federally declared disaster area designation works. That applies again to all livestock except poultry, where we can defer the income on sales excess of normal to the following year. Now, the one that only applies to draft, dairy, and breeding, that's the 1033E election. It basically, again, looks at a drought situation. This can be designated by the drought monitor or the Secretary of Agriculture designations, saying that we have a drought. The drought monitor for extreme, exceptional, severe. Then we can apply the rules there. Essentially, it boils down to the draft animals, dairy animals, breeding animals that we sell in excess of normal. We have 2 years to replace them. Now, if by chance that we get into a situation where that the area or the county is declared a federal disaster area, then we have 4 years to replace those animals. And if the drought continues, the designation can continue. We can kick the can down the road even further and then replace those years later. We've got two counties, I believe, in Oklahoma right now that have been in severe drought or better for the last 11 years, and we're still kicking that can down the road. So the rules that apply there, remember, they keep changing. I'll probably be doing a webinar strictly addressing that here in the near future, so be aware that that is probably coming. Questions, comments? You got hit with a very fun topic this morning. Probably ruined your lunch. Acid indigestion can be solved with Tums, etc. Looking at the chat.
Thank you very much, JC. I'll go ahead and ask you the questions if you don't want to have to multitask.
Okay.
Lydell Ellis asked, how do you determine the cost basis of a farm-raised breeding cow? Or is that even necessary in that Form 479?
Great question, and I failed to mention this. A raised breeding cow is the only tax shelter that still exists in the IRS code. The cost of raising a cow from the day she is born until she goes into the breeding herd, those expenses are allowed as an ordinary deduction on Schedule F. So when that cow goes into the breeding herd, her basis is zero. And it remains zero until she's sold. So if you sell that raised cow in 10 years and that cow sells for $1,000 or $2,000, it is all capital gain income subject to the maximum rate of 20%. So great question. What happens with a raised cow? It's a very unique situation. Her costs are deducted and she gets capital gain treatment. Now, this is a kind of an interesting story. Many years ago, I got a call from an IRS agent that was working on the audit technique guide for agriculture, and he asked me to give him in a short synopsis, get ready for this, a short synopsis of the life cycle of a cow. After 3 days, he finally figured out that he had enough information. So it is something that's very unique, very, very much a great thing for farmers and ranchers, because a beef cow has a raised animal, has zero basis. capital gain all the way. All right, next question.
If in that situation where the wrong form was used for the 4797, can this be recovered in the next filing or amended in a return?
It can be amended back 3 years. So you can go back and amend the prior 3 years returns. And that's what I had these farmers do. So we went back and fixed it. So as long as the statute of limitations hasn't run out, it can be amended and it can be fixed. And only problem is right now, under current situation with the IRS, it takes a little longer to get some of these returns processed than we used to have in the past. We've still got a bunch of tax returns that haven't been processed. So if you amend a return, be patient. It will happen. It will get done.
That's a fairly inefficient savings account right there, I guess.
Correct. And something that does happen with Oklahoma Tax Commission, you here recently, they've been sending out information seeking letters to farmers and ranchers that filed a 4797, wanting additional information on what was sold. So if you get one of those letters, again, get with your accountant. It's nothing bad. They're just after information. All right, next.
We have sold 35,000 more in cattle than usual because of the drought, and will not be able to buy back any replacements because of the drought. What do we need to do?
Okay, there's two things to look at here. So you sold 34,000, and when you said more in cattle, if it's market animals, all you'd want to do then is take that 35,000 and move that into next year and report that income on the in 2023. So you've got a portion that you're going to report in 2022 and a portion that you report in 2023. Now, the question that comes next is if it was breeding animals, you've got, and you don't think you can replace them next year, again, you may have 2 years to replace those. A lot of times what I've been telling folks here recently is we're pretty sure that tax rates will probably be going up in the near future. If this does happen, it may be to our best interest to report that income in years that we have lower tax rates. I anticipate tax rates going up, probably not in 2023, but probably in 2024 and beyond. We're going to have to recognize some of the deficit and see if we can't get some of that lost dollars recuperated through taxes. If you are looking at it the way I'm looking at it, it may be worthwhile to go ahead and report the income this year and look and see if we can move the income back using income averaging to the 3 prior years, offsetting some lower tax brackets, or moving it, splitting it between this year and next year. Again, looking at managing the income that way. So you've got several options to play with here. It's just a matter of sitting down with your accountant and let's see what the best ones are.
Okay, that appears to be all the questions from the 10 participants.
Paul, I've got a question. So are you hearing me okay?
Yes, we hear you, Dave.
Okay, so JC, if let's say someone keeps more heifers than usual, keeps all their heifers and breeds them, how long would they need to hang on to them? And maybe you said this earlier, but before they qualify as breeding animals and just are only subject to the capital gains, how old do they have to be, where you could market them at a point where they're considered breeding animals?
What you're looking at, if you're holding replacement heifers and your intent is to breed them, she has to be 2 years of more than just over 2 years of age.
Okay.
So 2 years and a day. Then she gets capital gain treatment.
Heavy with calf or have just calved basically at 2 years of age. And then at that point, she qualifies as a breeding animal and you're only subject to capital gains on her.
Correct. So
Very,
if she hasn't had a calf and she's bred, and then yes, qualifies because she's a breeding animal or had a calf at her side, definitely. So yes, there's the rule, it's 2 years.
Right now, we've got a lot of people having to sell more cows than normal. Eventually that'll flip around and people will try to, rightfully so, take advantage of the tremendous market we'll have for replacement females. And that shelter right there would be really advantageous for a lot of folks.
It's a great thing to use. You're correct.
Very good information. Thank you, JC.
You're quite welcome. Thanks for having me today.
Well, with that, we're going to end our Ranchers Thursday.
One thing, if they do have questions and they want to send them to you, or if they send them directly to me, I will answer them. So no problems.
Excellent.
Whatever's easiest.
JC's contact information is on that final slide. Take a second to go ahead and jot that down if you feel like you're going to need some advice on this subject. There's a lot of moving parts on it, it seems. Okay, with that, we're going to